Flexing ain't discreet about it. Extra read about it. Say you wanna beef about it. We gon' come and see about it. Flexing ain't discreet about it.
Welcome back, you guys. So this is Outlier 5.
Episode 5, yep.
So last week we kind of talked about new builds and kind of the housing crisis a little bit. Today we're going to go a completely different angle, talk about investing, specifically in real estate, something that I have knowledge in. I've done it a couple times now. And on your end, you haven't done it yet, and kind of want to get why you wouldn't be interested in it, maybe some things you've heard about it, good and bad, and kind of take that angle. And then we're going to walk through 2 deals actually that me and a business partner of mine, he'll be on the podcast at some point, but kind of walk through the numbers, how it's working for us, and kind of go into it.
Yep, and I've got a interesting perspective because I've been vocal with you about my thoughts on real estate investing and why I have those feelings, and working at an investment firm, all for traditional stocks, bonds, mutual funds, equities, etc. REITs are even in there, right? Being exposed to that, and then seeing the standard rhetoric on social media about real estate investing, which is like, we'll get into, but not real, for lack of better words.
Right. And I'm going to preface by saying that I started the real estate investment journey about 4 years ago now. And even my mindset's kind of shifted from where I started to where I foresee this going further in the future. But so I guess just know that. I guess when you see the numbers and see what we did, I wouldn't necessarily recommend people do that because it was a little more leveraged in terms of debt than I would prefer now. But it is what it is. It's how I did it, and you can't argue with the numbers. So.
Yep, and I am, I am, compared to everybody else, especially on the internet, I am even further, away from everybody. I'm like, no debt. And that's a piece I'll get into as we talk about that of long term. And, let's get into it. So you got this PDF you drew up for me. You want me to pull it over? And
yeah, go ahead.
Pull it over here. Okay.
So I'll just preface by, especially people out there may or may not have heard of some of these. So a lot of these have become more popular, especially after COVID and stuff. I personally got into, I guess, real estate in general from having a bad experience with a realtor. And then off of that, I kind of got into the Rich Dad, Poor Dad, and that kind of brought me to the investment side of it. And then I found BRRRR. Shout out BRRRR. They're a massive real estate forum and blog, and they have a podcast. And so that's really where the wheel started turning. It was like, okay, like I can see where the money makes sense and how people are making money. And I mean, Kiyosaki talks about it all the time, but real estate has made the most millionaires out of any other investment. So yeah, I mean, with all that said, that's why I first got into it.
Quick, yeah, that just made me think of something. I told you about this a couple months ago, where this person on, it was social media, but he was a reputable person. I can't remember his name, but he said like, oh man, it was like 98% of millionaires own real estate, and then it was like 100% of billionaires own companies, or something to that verbiage, right? And yes, private equity, exactly. And that sparked a conversation between me and you, because there's some nuance with that as well, even the labeling of the private equity. But his sentiment was you have to own businesses to be a billionaire. You can't do it through real estate. Well, I'm curious about the labeling, because the thing is, people who are invested in real estate at a high level for investment purposes rather than their personal home, because that makes up a lot of the millionaires. Look at Dave Ramsey show is a perfect example. They're doing that through businesses rather than their personal names, how normal consumers are, which is a large portion of their net worth is their home. So that's something, a little twist on it, but also, because it's funny, you've been investing in real estate for 4 years, right? For a long time, I was very like, no, I have aged in my opinions on it and changed a little bit as a view towards my side. We've kind of pushed and pulled each other, a little tug of war game going on. And now we're kind of both in this like happy medium ground of like, still on the other side of it a little bit. You're still on that side a little bit, but we're pretty dang close.
And to that point, you bring up a massive aspect of especially real estate investing is there's levels to this thing. And there is with everything, right? But it's more pronounced in real estate because you can be, that quote unquote scum landlord or whatever, and just hope to make a couple $100 a month or whatever. But then you get into the development deals and like a Grant Cardone type of level thing, and he's doing $500 million deals every other month. So it's levels like anything. And to your point of yes, you come from the more conservative Ramsey route, let's say, which I subscribe to Ramsey. Don't get me wrong, real estate Ramsey trusted here, but initially I subscribe more to Kiyosaki of like, yeah, debt isn't great, but there's better ways to leverage debt. And so we've kind of met in the middle, I think. So with that said, I'm going to throw it to you then. What were your apprehensions about investing in real estate?
Ooh, that's a good question. Let me think about this. Too much. Everything for me came to a comparison to S&P 500. Insert whatever, right? Insert traditional investments or bond stocks, stocks, bonds, mutual funds, equities, that realm of stuff, right? As a comparison, it's like I perceived it as more risk and more active investing, right? Versus a set it and forget it, index fund, whatever. So that was the first thing I was like, well, why would I really get into that? And this was in my younger days. Obviously, we'll get to what I've learned as a comparison, but that maintenance cost, right? That was something I didn't like the idea of, and this is all coming from mainstream Instagram, TikTok, whatever, of the leverage. I hated leverage because the thought of doing that in a non-qualified investment account in a index fund would be absurd. So why is it okay in real estate? It was like a weird paradigm for me to shift into of like, what? That's if you're looking at it as your home versus an investment, it's a different thing. So then if I were to tell you, yeah, I'm going to take out X amount of loans to invest in the S&P 500 over the next 30 years, you'd probably be like, well, what the heck are you doing? That's dumb, right? So at the time, my thoughts, I applied that reverse engineer. I'm like, so why are we okay with doing it with real estate, but not S&P 500? They both over the long term have the growth, the trajectory of going up, right, and growing in value. So why is it okay for one thing but not the other, right? So that's where I came from. That's why the Ramsey things resonate with me. Whereas like if you can't afford to buy out to make that investment outright, why are you just okay with leveraging it?
And you bring up good points that you can't really argue with. So in terms of passive investments, real estate, especially if you are your own landlord and doing your own maintenance, it's not that passive, right? There's active things you have to do of maintenance and upkeep and collecting rent. And whereas if you just dump it into a fund, like you said, you just sit and forget it, But caveat to that, what geared me more towards real estate was it's tangible. It's something that I actually have somewhat control over. I have control of how it's maintained. I have control of where I buy, what I buy. And you have that degree to stock, obviously, what you buy and what price point, but you don't have any control of how the company does. You have no control outside of that. Whereas a rental or a real estate property, I could go on and add an addition. I could add upgrades to get the equity up. There's different ways you can get creative.
Buy the house next door, which something you did, right? Increase the value in that house and makes the value of yours go up, the other one go up as well. And what I will say is, as a quick note, this shows the importance of language and verbiage and labels, right? Because people labeling, people labeling real estate as passive investment, that's not true. It doesn't mean it's a bad investment. It doesn't mean it's passive though.
It can be passive if you are willing to pay to have a property management company. And there's ways to make it as passive as you want, but you're going to pay for it.
Yep. And they don't talk about that. They just say, oh, real estate's passive. Well, look at the Airbnb craze of 2019 to 2023, right? That was the perfect thing. You saw it over all these gurus on TikTok and Instagram all the time. Just get an Airbnb, when you list it, you make all this money. I made 80 grand this month on Airbnb. Well, how are you guys doing now? Okay. And that was another thing, right? So that's where the leverage part doesn't come in. So but my point was that shows the importance of language and labels. So it's like, you guys, it's social media. People don't like being honest, right? And being transparent. We do. But comparing it to the S&P 500 is not an apples to apples comparison. That's what I then realized over time in my old man wisdom, my 25-year-old wisdom, right? That was one aspect I kind of came to realize.
And not to speak for you, but I'm sure it helped seeing like, oh, it's actually working. And now he's done it 4 times over and the model works. Mm-hmm. So, I guess anecdotally is like, okay, like I hear this stuff from the peripheral of like the loud noise and like the bad things that could happen. And I'm sure they have, and they do. But on the flip end, you see like, oh, my brother's doing it and it's making money. Like,
he's got 4 of them. And yeah, so let's talk about the thing you got here. What is, so we see buy and hold, fix and flip, BRRRR, house hack, commercial, like explain these first and foremost.
So there's different types of real estate investing. There's buy and hold, which is just the classic of I buy something, I hold on to it forever, and appreciation will take over. And eventually I won't owe any money on it, but it'll be worth X amount. That's just put simply buy and hold. Fix and flip is not, I wouldn't actually consider that real estate investing. That's more of an active, like you want to talk about active. I mean, the turnover is, I'm going to buy a house for $100,000. Well, let's use easy math. $100,000. If I put 30 into it, I can sell it for 200. But you're actively doing that. And like the way fix and flippers make their most money is by how quick they can get these things turned over, right? If you buy something to fix it up, which is something we dealt with, and that's another thing is like and this, you were actually semi a part of it, kind of tried to do a fix and flip type situation without knowing what the hell we were doing, and got family involved with their dad and got help, and we ended up breaking even. We didn't lose any money, but I gained so much knowledge that I was able to take into these ones that we're going to talk about. And then you'll get to a point where like, and this is where I got, and I talk about this to my business partner, everybody, is like, you can only read and research so much before you just got to pull the trigger and figure it out yourself. And that's where I got to. I've been listening to Bigger Pockets, listened to hundreds of all the episodes they had, read all their books, read everything I could. And again, at some point it's like, okay, I think I know what I'm doing. I got to jump in the pool and start swimming, and that was our first fix and flip. But anyway, I digress. Then you get into BRRRR method. This has been really popularized by Brandon Turner. Shout out Brandon Turner. He was part of Bigger Pockets. I think he actually coined that term BRRRR, which is now everybody's kind of taken over. And this has been popping on TikTok lately. BRRRR is buy, renovate, rent, refinance, repeat. Okay. This is actually what I'm doing. And then there's house hack. House hack, we've talked about that. It's a great way to get started investing because it's about that perfect middle ground of the idea is you buy a multifamily, duplex, triplex, quad. You live in one unit and the other 3 are rented out, paying for your mortgage essentially. So you're ideally, if you do it right, you're living for free and then making a little bit on top of that. Great way to get in. If I could go back in time, that's how I would start. Then there's commercial, obviously. So you get into retail spaces and actual leases with businesses, blah blah blah, and then multifamily apartments. Again, levels like we talked about. Right?
Quick note: commercial's dying. We talked about this a couple times ago.
It is.
I would not recommend anybody get into commercial unless you're going to get into commercial to rehab and renovate the entire thing to make into apartment complexes.
Agreed. And like there's like we eventually wanted to get, like, I'm not into commercial at all right now. I eventually want to get into that space, frankly, as a problem solving for us of like, we need commercial space. So it's like, well, we might as well buy something and then ideally like have apartments above it to pay for it, whatever. But you're right. Of all of these, I'd focus on multifamily. If you had an option, it's the harder threshold to entry. Which is why I'm not involved in it yet, because it's expensive.
Well, quick note. So then if you're talking to an 18-year-old kid who said, I want to get into real estate investing, would the order of operations that you would recommend would be house hack first, and then BRRRR, and then eventually multifamily? Was that?
Yeah, I think so. Because the beautiful thing about house hacking is you can even get up to a quad with a FHA loan. So that's only 3.5% down. So in terms of barrier of entry, that's your cheapest way. And then again, ideally, if you did play it exactly right, it's like, okay, you live in that unit for a year, you rent out the other 2 or 3, and then turn around in a year and refinance it, and then just do that again. Buy your next multifamily and live in one, and you just keep repeating that. And so it kind of takes over of house hack, turn to BRRRR, turn to, it kind of snowballs. In terms of criteria, everybody's going to have their own niche and like things they're looking for. And I'll be honest, like one of ours doesn't even fall into the 3-bedroom. We did buy a 2-bedroom. There's a different reason for that. But at the end of the day, you want a decent area, right? Decent schools, look around the neighborhood, who's around you, what houses look like. And again, wiggle room, obviously, with purchase price. You want to be able to have that equity and or add equity to it by updating or adding a bathroom, doing something. You want to be able to add equity to what you're purchasing. Ideally, a 3rd bedroom. 3-bedroom, 1-bath ranch is like your bread and butter all day long. Everybody will need one of those at one point in their life. If you can find one with a basement, even better. But that's like your bread and butter. Like, this will solve a lot of people's housing problems of a 3-bedroom. Kids or not, it doesn't matter. So that's kind of my, basic criteria, if I had to break it down. In terms of area, please, I would recommend knowing that area. So I focus on areas that I know. You can do the out-of-state thing or out-of-area thing. And again, that's where ideally even you have a property management company handling that, so you don't, if you're 2 hours away, you don't have to be worried about it. But if I had to just, put a blank template of this is how you do it, it'd be that, okay? So then we get into the BRRRR. So we're going to talk about 1 and into 2 deals that me and my business partner have done, okay? Kind of getting the math on it. So we purchased this house, we'll call it G1, for $55,000 in 2020, okay? We got lucky. I'll put that right now. We got lucky in that we purchased it for 55. During that purchase, it appraised for 70. So right away, we're like, okay, we got 15 grand of equity right off the rip. Then we had to put some money into it. We bought new appliances. I had to update the electrical panel, painted everything. So that was about 5 grand. So let's say we're in it for 60 as a whole. Actual cash, though, is about $16K in closing costs. That's one thing I'll just say right now. We were purchasing it as a rental property, and so it's not owner-occupied, and that's the key. Owner-occupied is the key for your down payment threshold. So since we were not, we had to pay 25% down. So that's why, even at 55K, it was 16 grand at closing, okay? And then with the roughly 5K in updates, we're at 20 in terms of out of cash, right? Or out of pocket cash. So we did that and got it rented for $1,200 a month. Our mortgage payment was $700 a month. So right there, we're making $500 a month cash flow, okay? We did keep some set aside, and I'll just be upfront with you. I have yet to take actual money that I haven't spent from this. I'm not taking any monthly money right now. We're just having this bankroll so we can buy more. And with that, it's kind of allowed us to build a nest egg of maintenance for CapEx, capital expenditures. So even then, okay, we're cash flowing $500 a month. So the house is worth, at this point, about $75K, and we owe $55K, okay? So we got 20 grand of equity right there. We then had another property that we purchased prior. So this was actually our second property. The first one we bought all cash. We got a crazy deal. I won't get into details on it, but we got it for less than $500, okay? We had to put a lot of money into it, though. We had to put about 20 grand cash into it. So with that said, that one we're in 25K of actual cash, plus let's say the other 20K of actual cash. So we're in both of these for like 40, 45 grand cash. The first one that we bought for cash, we put 20 grand into it. It was new siding, new furnace, new AC, paint everywhere, new appliances, refinished hardwood, new flooring. We did a lot. But it got to the point where that house was then worth about 65 grand. So we were only in it for about 20, but it's worth 65. And on the other one, we already have 15, 20 grand equity. So just between the two, we already at 60 grand equity. So then we went and did what's called a portfolio loan. So we're like, okay, we shelled out a lot of cash and we are cash poor right now. We have a lot of equity, but that just does us no good. So let's recoup this money back so we can, again, go buy more and just keep this thing running. So that's what we did. We found a portfolio loan. So what they do is they take mortgage of one, being G1, so the one we bought for 55K, and they take the other house, which had no mortgage, and we're going to combine these two and make one mortgage. Okay? So with that, there's a loan to value, LTV. So they took, and I'm kind of bouncing around, I apologize. But once we got to this point with the upgrades we did, and this was 2 years later after purchasing, housing market kept going up. So we went to the bank and said, okay, this is what we want to do. They had to get appraisals on both houses. So G1 appraised for about 95 grand. Okay. Keep in mind, again, we're only in it for about 60 on paper. The other one, P1, we'll call it, the first house we bought in cash, appraised for about 65 grand. So the two of those combined is about 160, right? 95 plus 65. The bank is like, okay, your whole thing's worth 160. We'll give you up to 70% of that value back, and then the remaining, 30% will be mortgaged or whatever. So all in, we had about 23K invested, ended up appraising for 65K or so, LTV of 70%. So we got about 112 grand. So they said, okay, it's worth 160. We're willing to give a mortgage out on 112 of this. You can get the remainder back. Okay. So 112 minus 55K and closing costs, blah, blah, blah. We got 65 grand back. And now we have a new mortgage for the two houses combined for 110 grand. Does that make sense? Mm-hmm. Okay. So what does that do? Well, that paid us back all that cash we put in and then some. And the P1 was rented at the time, $800 a month. It is now $900 a month. But with that said, so we were able to get 65 grand back and a new mortgage for both houses at just under $1,100 a month. And that includes interest and tax and insurance too. That's all under that. So not only did we get all that money back and then some, but then we're G1 got now rented at $1,300 a month because rent rates kept going up. So now that one house alone is paying for the two, plus $200 a month. Let alone P1 is rented out for $900 a month. So combined, we're getting $2,200 a month minus the mortgage cost, which ends up being about $1,100 and some change in cash flow per month. So the math is mathin'.
Yep. Because I want to come in here and say something real quick. Because let me talk about some of my apprehensions and how those have evolved and things like that, right? What I hate to see, this is mainstream people, this is not what you guys did, and I'll get into that, but they over-leverage themselves to the gills, and then they're paying their own mortgage as well, or they're paying their own massive rent payment as well, and they're praying nothing breaks down and renters don't, they can get renters, right? It stays occupied, right? Because if one of the two are going to happen, they're screwed, and now they're late on either their own payments or the mortgages for their investment property to the banks, right? And they're going delinquent. With this is, right, this falls into my Dave Ramsey type stuff where ideal world, want people's mortgages to be less than 25% of their take-home pay. You two combined, this is way less than 25% of your take-home pay. And therefore, if you both had no tenants in there, you could still pay it. and not be fine, or not be screwed. You guys are fine. You're good, right? So at this, you guys could still go get 2, 3, 4 more until it starts getting to that threshold of more than 25% of your take-home pay.
And that's a great point, because now we do have 2 more than these, and we are now at that point where it's like, okay, we need to sit back, start paying down this debt so we can go back and get back again. But it got to that point where you're just like you're saying, is like, hey man, we're getting over leveraged now. Like it's a little too much, where if something bad happens, we might be screwed. So
yep. And that's why when we started talking about this and everything, as you're doing it, and I'm like, yeah, I'm cool with this, and I was like, once you guys have the cash, pay it all off. And you're like, kind of hit like, I don't know, like, yeah. I'm like, you can, if you paid it all off and you just did this again, you just paid 4 off, right? And you guys are able to get 4 more at that, and then 3 years after that, pay all those off. Within 10 years, you're going to have 16 properties all paid off.
And you're right, because if we're able to get all 4 paid off, whenever that is, in terms of rent rates now, it's like we could cash flow about $4-5 grand a month. And that's real money. I mean, that's true passive income.
Yep. And then times that by 4, right? So you guys would be making, let's say, 16 to 20 grand a month. If all 16, over a 10-year period that we're talking, is all paid off, you're making $16,000 a month cash flow with no debt.
Yep.
This is what I'm cool with, right? Because now that falls into my investment philosophy of don't take out massive amounts of debt that you couldn't pay if the world started burning, right? To try and make money. To me, it doesn't make sense, right? Compare this to all the stuff you see on social media, right? It's vastly different. They say over leverage yourself completely, and they took certain bad advice from people like Grant Cardone. Like, screw it, I'm just going to rent, and then I'm going to over leverage myself on these houses, and if one thing goes wrong, I'm screwed. If you lose your job, you're screwed. You have other consumer debt, because he's not also telling you to pay off all that consumer debt. That's one thing I'm a big proponent of. Pay off all your consumer debt, get a big nest egg, and then start investing. This type of real estate investing, which is one of the only ones that I am cool with, is just a different type of investment strategy compared to index fund, S&P 500, that type of thing.
And one quick adage, like if you do it this way, one day we'll actually sit down and go through the numbers, because we just bought G2, let's say. So we bought the neighbor of G1, and we got a deal on that, bought it cash, older dude, and it was probably worth, I was honest with the guy, like we always are. I was like, hey man, it's probably worth about 45 grand if I was to buy it to fix it and live in it, but that's not what I'm doing. So we'll give you 18, 20 grand and give us that money that we're talking about to put into it so that it is worth X amount after the fact, to give us that wiggle room. But the old adage is you make money the day you sign the purchase, because if you do it right, that's exactly what it is. There's a bunch of ways to invest in real estate. And again, not to say that I would recommend everybody do this, but in terms of transparency and showing you what we're doing and where we're coming from, this is what I did and am doing. And hopefully you will, I've learned a lot, and that would be a podcast in itself of the things don't do, because I did it and learned the hard way. But you can only read so much. There's smart ways to do it, like everything else. Try and mitigate that risk, and just don't be scared, you guys. There's good ways, people like us out there that walk you through it, help you. I've gotten plenty of people invested in real estate because they came and were like, hey, help me do this. So that's definitely why we're here.
Yep, and to kind of bring this full circle back to where I was at the beginning, right? I was more apprehensive about real estate because I was like, I'll just buy it in cash. If you're going to do investment, just buy it in cash. Kind of, again, if I were to take out leverage to invest into an index fund, you tell me I'm crazy, right? Granted, they are different things, but what I would recommend to people is there's nothing wrong with investing in real estate if you do it the right way. You don't over leverage yourself. Just how there's different levels of real estate investments, there's also different levels with your finances that you progress through that to do it continuously in a smart way, where you bulk it off. And like these two as an example, great, perfect, okay, this is still less than 25% of our take-home pay. Even if we had no tenants in there, great, we can get 2 more. Okay, now we're at the point for our personal thing of we're not going more than 25% of our take-home pay. Now, compare that to most people getting normal mortgages that they're living in. That's 40% of their take-home pay, which we don't recommend doing that, right? But so people tried to take their, I'm living in it, so I'm going to do 40% of my take-home pay goes to my mortgage, but I'm going to prescribe that to my investments as well. Don't do it that way. Don't do it that way. If you do it this way and keep yourself in a good budget and level up with it, then it makes a lot more sense.
Peace.